Well, joining us on the desk first this morning is Theo Vorster. He's the CEO of KSL Online. Theo, thanks for coming in this morning.
Good morning.
Theo, it looks like we still have some caution in these markets. We're seeing results continuing to be churned out of the United States. On the most part, they do come in better than expected, particularly on the banking side. Yet we still have this note of caution. And of course, Morgan Stanley and Goldman Sachs hanging over the markets, of course, Goldman Sachs with those fraud charges. What do you think is driving the markets going forward from here? Is the focus going to shift away from results and onto the Goldman Sachs fraud charges?
Look, I think the Goldman Sachs fraud charges is more of a political charge than a legal charge. And I think we know that the administration is in the process of trying to get banking regulation through Congress and is trying to debate the terms of that regulation. And I think this will give a lot more impetus to the regulatory drive. The fact that this charge might not stick, and the fact that we now know that two of the commissioners was actually against pushing these charges, I think that's debatable. The question, however, is that I don't think we should underestimate the resentment from the regulator, from the public, towards banking bonuses and what they perceive to be the environment in which banks were operating. So I think what we will see is we will see a lot more stronger clauses in terms of the Volcker clause, the fact that banks will have to split their businesses, the fact that banks will have to carefully look at what is the trusted advisory business and what is their trading business. And I think this will politically give impetus to all of that. And I think banks, as we see them now, in 5 or 10 years' time will be completely different. We'll see big changes in that. Remember, a regulator cannot take away all of those things. He can't police it. But we will have to get to points where there's more price clarity and some kind of central clearing mechanism for these products. And I think we are going to move towards that.
Well, you're talking about moving towards a better regulated environment with regards to the banking system, and you're talking about the split. Just looking at proprietary trading and the impact that it's had on US banks' earnings, it's been positive. Yes. And of course, banks have started to make quite a bit of money by taking risks once again. So if we do see this split, I assume that the banks globally won't be making great profits going forward.
Banks will look differently. How they're going to restructure that is a different question. From a shareholder point of view, remember you own all these entities, you all own all these activities. So if banks will be different in 3 or 4 years' time from now. I also think if you look at what we are currently seeing from the banking profits, if you look at the big banks' profits in America, there's 3 themes coming through. Number one, the capital adequacy ratios is a lot better. That means the gearing of the banks, if you look at Tier 1 capital, all is between 10 and 12%, which is better than 2-3 years ago when we were at 4-5% in the US banks. Gearing is better. Their ratio, their bad debts provision relative to their book is a lot better. So therefore the banks are feeling slightly more better about that side, bar for Citibank. Citibank was completely the other way. If you also look at their growth in credit, the banks are actually starting to extend credit. Perhaps the man in the street's not feeling it, perhaps it's not all around, but we are seeing in the numbers that we're seeing that market coming to fruition or getting unstuck again. It's a slow process, but I think the theme would be is, if we go forward, it's where are we going to see banks in the future and how will they look? I'm not sure where we're going to end, but we're not going to remain in the same space.
Of course, you say there is signs that they are starting to lend again, but all the profits that we're seeing coming out of the banks at the moment aren't from their lending activities, it's really from trading activities. Yes. And if you're going to be splitting those going forward, they're going to have to really get those lending activities growing in the next couple of years quite strongly, otherwise they're not going to be profitable into the future. Yes,
and the key from the Volcker rule, or what Paul Volcker presents, I think was going to be a lot less in the regulation than what it's going to be now. All of a sudden, after we saw these charges against Goldman Sachs, and that's why I come back, that was a political motivation. It's a political charge more than a legal charge, and it's a political indictment of the way they do business, and that'll give impetus to the restructuring of regulation and perhaps the restructuring of the banks going forward.
The IMF talking about debt traps, worried about the debt scenarios that are emerging, and especially in Europe. Greece being a very big point of conversation at this stage of the game. But one thing that the stimulus that we've been seeing from all these countries to try and get us out of the recession, it's a great thing, we're seeing growth, but it's also put us in a very difficult position, in a debt position as well, Theo. How do you think this is going to play out? Because we're seeing it happening in Greece, and it's a very small country, but if we do see one of the G4 countries or G8 countries in a similar scenario, I mean, that could create quite a lot of havoc globally.
Look, there's 2 questions there. the first question is, what will it do to consumer spending? Because the taxpayer will have to repay those bonds. They'll have to service the debt on them. So what will the impact of this debt burden be on this generation, even perhaps future generations? So therefore, you will see government having to take more money from consumer spending in order to service these debt obligations. That's the one side of the coin. The other side of the coin is the government's ability to actually service that and to actually get the taxes. So and that is more of a concern of sovereign debt where we are in the Greek situation. Now, the Greek situation is a point where the markets took a view and say the Greek economy will not really be able to, or there's a question about their ability to fund these, to do these rollovers and to keep on funding the debt. So therefore we had somebody to step into it. The question is, Greece is it's 2.5% of the EU's GDP, but the point of fact is it's massively big from a principal point of view. If one of those EU countries were to default in some other way, it'll send shockwaves. The problem is if we come to a bigger country. So on the consumer spending side, I don't think we really know exactly where that's going to end up. And if we can't get growth, that debt burden won't be able to be worked out the system. On the sovereign debt side, I think that's where we see the rates where they are now. I believe that there's a few countries that will have to tighten their belts incredibly and get growth going. How else are you going to get out of that? You're going to get out of it by getting growth going and curtailing government spending. How do you get growth going if you're going to have to increase taxes? So it's a fine balancing point. The answer in the long term is to try to get proper GDP growing so that you can easily be or in a better position to be able to pay off these debts.
Well, staying with consumer spending, and here I'm going to put you on the spot because we've just had Clicks results released. Headline figures, retail turnover up 15.2%, diluted headline earnings per share 24.5% higher, and that's at the top end of their trading update that they put out recently, saying headline earnings per share would rise between 20 and 25%. So this is a continuation of the very strong results that we saw coming through at the end of last year, and really just showing that it's in the defensive parts of that market and benefiting from that. Yes,
having seen this just now, turnover up 15%. We're in an inflation environment where inflation is about 6%. So this is actually a great set of results. So they had real growth in turnover. If you now look at the fact that the headline earnings per share is up 24.5% versus turnover 15%, that tells you there's efficiencies. There were cost cuts, there was probably logistical efficiencies, but that's positive for management. That tells you that from managing the business, management is doing a good job, and in this market to be able to achieve turnover growth of 15%, that somewhere along the line they stole market share. They got market share. I'm not exactly sure where it was in their business structure and where it came from, but if you grow at 15%, where the growth in retail sales overall is a lot less than that, where inflation a lot less than that, then obviously they did well. I think this is a good set of, from these two numbers, having seen it for a minute, this looks positive.
Well, Theo, I mean, we know that they've been rolling out pharmacies within Clicks, and I think that is working quite well. But at the end of the day, we also know that other retailers are starting to catch on. So perhaps it's going to increase the competitive environment for the likes of Clicks. Apart from that, one other thing that investors are concerned about is Musica and the role that Musica will play going forward.
That is a very difficult question. My view is that Musica is one of those companies that were caught in a change in technology, the whole CD music industry. And how they will remain relevant is a big question. And I think the key there is to what extent will the industry, the music industry, be able to adapt to technology. Incidentally, I was 3-4 weeks ago in the States, and you can't find a CD shop anywhere. You can't find a music shop anywhere. Not in the big shop. They're not there anymore. They just disappeared from the big mall. So the fact is, perhaps we need to read something into that. That music is something that will be bought and sold on the internet. It will be downloaded, and we'll just have to adapt over time to that principle. How it's going to happen, I'm not sure. I don't know enough about that market. All I know is that one must be careful and look very careful at that market, and try and make sure that you, if the trends internationally show you that we're going in a certain direction, make sure you're in that trend.
I'm afraid I still like sticking CDs into the old CD player.